Hi, this is Mike with Relational Intelligence, and we want to share something that's really, really important with all of you. And it's a financial weapon of mass destruction, which is the debt bomb. And the debt bomb is essentially consumer debt, which is credit cards and auto loans primarily. Of course, student loans are out there. That's a whole separate category. But when we look at credit card debts and auto loans, they're at an all-time high right now. If we look at the growth of that year over year, we're at 12 and 18% increases in credit card debt, which is not healthy for us as individuals. And why you should be concerned with this is that if you have credit card debt, meaning you haven't paid off the balance, then you're going to be paying 18 to 22% interest. And it's really hard to get ahead financially when you're doing that. But because it's in such small bites, we don't even really notice that it's happening. We can't tell. It's like we're in quicksand, but we're not sure why. And so when we're paying that amount, we're paying huge amounts of interest to the credit card companies. And it's because we spent more than we can afford. So when we look at overall credit card usage, it kind of falls into one of two categories. Transactors, those are people that pay it off every month. And then revolvers. And a revolver is somebody that keeps a balance on the credit card. We look at the national average, it's about $6,000 for somebody that has a balance on a card. And that's a lot of money. So if you're just paying the minimum payment, how long does it take to pay that off? It could take you 8 years to pay off that $6,000. In this case, it's $6,480 is the number that we used here on the calculator. But that can take you 8 years at that expected monthly payment. And if you did not have the credit card debt, and you took that same amount, same dollar amount over the course of that same time period, you invested it at 5%, which you can, gosh darn, get that in a bank account just nearly, then you would have $15,000 over the course of that time period. So you can see the dramatic difference that occurs when you're having to pay down those debts versus being able to invest for yourself. The second really important point that we want to drive home is what we think is happening right around the corner, which is the credit crunch. And the credit crunch is a combination of not only the increased credit card debt that we talked about, but right now we're seeing delinquencies are growing, meaning it's taking people longer to pay that back. That means that we're suffering a little bit financially and not able to pay those dollars back. An invisible hand behind all of this is what we call the money supply. And you might say, okay, well, Mike, what does that really mean? Well, remember during COVID, the federal government printed a lot of money. And this graph shows how much money was injected into the system. And now they're going to start pulling that back. So at this very moment in time, we have an interesting situation where our credit card debts are going up, and yet we still have money in the bank. So we feel pretty good about things. Well, as the federal government pulls money out of the system, the amount of cash that we have in the bank is going to go down inevitably. And yet, when that tide goes out, what we're left with is the credit card debt. So what's important to do now is get a plan together. While the economy is good, while you got a job, get a plan together and make a budget and get that paid down as quickly as you possibly can. You'll feel so much better about yourself. There's lots of resources that you can take advantage of online. We'll put a link in the description. And of course, you can always reach out to us for help.